Hello everyone and welcome to Market Bites. It's a special one today. We're going to discuss the latest retail investor beat. We'll get into that, what it's all about very shortly, but I'm joined by the dream team, Neja and Brett. Neja, how are you?
I'm doing well, thank you. I'm always excited about retail investor bit.
Yeah, no, it's great to hear what they say every quarter, compare it quarter by quarter, year over year. You get a lot of interesting data on it all. It's one of my favourite podcasts that we do actually, just to go through it. And I know a lot of people appreciate hearing the stats as well. And we're also joined by Brett. Brett, how you doing?
Doing well, doing well. Thanks, Sam.
Good. And you're in New York today. You've got a diamond event on, and Yoni I think is over in New York as well at the moment ahead of earnings. So yeah, I'm sure it'll be a busy few days for you.
Yep.
And all of that. And do you know what? Before we get into it, because obviously this is a sort of a follow-on from, you know, the market bites we do week over week. It almost feels like it's been a quiet start to the week. I don't know if any of you feel like that in the markets. And yes, there's been some big moves, but it almost feels like the first three and a bit days, it's been one of the calmest of the year. Do you feel that, or are you like, no, actually, a lot has gone on?
That's why I'm afraid what's coming, because
Yeah.
always when it gets just a bit quiet, something big's gonna happen. I have no idea what, but I'm sure that it's coming.
Yeah, true.
Yeah,
It's a
I mean,
little bit worrying.
a couple days into the year, we had, the news with Venezuela, and then, every week it's like it's crypto, it's software, it's silver and gold, it's everything's moving. It's like you said, it's a little quieter this week. What's around the corner?
Yeah, the calm before the storm. So for everyone listening to this, enjoy it while it lasts. But what we are going to discuss today is our retail investor beat, which we do every quarter. And these results were a survey that was conducted October the 30th to November the 13th, so the back end of last year for to be produced now, and over 10,000 retail investors, I think about 11,000, 13 different countries. They don't need to be an eToro user as well. So over three different continents, we get this data, and we can learn a lot from it. It's always interesting to hear what the retail investor says, and Nesha, you mentioned you find this one interesting, and I know a lot of people do as well. So, I mean, Brett, I'll come to you to sort of follow up on that. Would you agree with Neja and myself that it's always interesting just getting an idea of what retail investors are thinking?
Oh yeah, I mean, not just interesting, but I think it's important too to know sort of what retail, where their heads at with things, especially, at the time when we did this survey, we were sort of in that period where we didn't know what it was going to turn into, but it turned
Mm.
into a 5% correction. And, on social media, it felt like it was a 15% correction. Felt so overblown, but to read through the results of, retail investors on this survey felt a little bit more reassuring that they weren't getting so caught up in the emotional side of it. But just broadly speaking, even outside of this last quarter, retail makes up, sometimes they make up a third of the daily trading volume. It's no longer this little 3%, 5% slice of volume. It's a pretty significant chunk. So to know what they're thinking, what they're doing, I think offers a lot of insight.
Yeah, for sure.
Yes,
And it holds a lot of weight, doesn't it, Neja?
yeah, I think that sometimes people are all of us investors are focusing most what hedge fund managers are doing, what really big investors are doing on the market. But as Brad mentioned, retail investors make up around a third of stock market. So also how they are thinking, it's very important for market moves and also to see what's the sentiment on the market.
Yeah, for sure. And I remember there was an FT article probably March, April last year. And, we brought it up a few times on the podcast before, and I think it's from the FT, and they were saying, who's going to win, retail investors or, the institutions,
Yeah.
because retail investors were buying the dip, and it's gone all right since then. And I guess this has kind of helped measure the sort of the tagline of the dumb money retail investor to sort of, starting to be removed, really. That label has been left behind. I mean, based on the data that we've got, what sort of specific behaviours have you sort of noticed from this? And the mature sort of retail investor is here to stay.
Yeah, actually, that's one of my favorite parts of the report because it really challenges this stereotype of dump money and that retail investors don't know what they're doing with their money. Because when you look at the data, it's really not that hype driven anymore. Because about 70% of retail investors actually actively review their investments, and this tells us that they are engaged and they're just not just buying something because it's trending on social media or some neighbor mentioned some company to them and investing and forgetting about it. They are actually reviewing and monitoring what they own. And also the consistency stands out because around 79% they are investing regularly every single month. So, and we know that consistency is one of the most important things when it comes to investing. So I think that's huge. And it's not just trading, it's actually building, and it's long-term thinking, something that we don't often associate with retail investors. And what experts are highlighting is that shift in mindset, because it's less opportunistic, it's less reactive, much more consistent. So instead of chasing the next breakout stock like we saw in 2021, I'd say that retail investors are more behaving like asset allocators. And I think that's a big evolution, not revolution, evolution. We can see that they are learning and they are improving. And I think that's very important and very good to see for the market.
Yeah, I completely agree. I really like that stat there. 79% invest regularly every month. And, for a lot of people, not saying this is exactly what they're doing, whether it be that dollar cost averaging approach every month into something rather than just investing in whatever it might be. But that can really help with the psychology and the risk side of things for a lot of people. So that's encouraging to see there. And it's not, just a case of just maybe do a bit here and then in a few months a bit there. It's, I'm doing this for the long term. I'm going to invest in every single month and hopefully look to compound that over time. And, fair play. Good decisions, I say, for now. Brett, the next question, and we sort of look between the age groups, because obviously the study, when we ask the questions, they've got to give a little bit of insight about their age and their gender and all of these kind of things. Are there any habits you sort of noticed if we look maybe to Gen Z and millennials compared to the boomers of the world? Anything stick out to you?
Yeah, I mean, I think to Nej's point, a little bit less chasing the breakout stocks, a little bit more weight into the consistency, and that's not a concept that's being lost on the younger generations. You mentioned about 80% of investors are investing regularly every month. That number is actually a little higher for Gen Z and millennials at 87 and 86% respectively. But in the US, it's actually a little bit higher. It's 89 and 90%. And I know the U.S. one is all I've been talking about since I've been in New York with doing all the interviews and whatnot as U.S. rib. So, but generally speaking, it's pretty broad across the world. Gen X and Boomers are also do pretty well at 80% and almost 70% respectively. But the key idea here is that investors are regularly and consistently investing in the market. I think maybe for the younger investors, it's interesting because how many of them came to the market here in these last 5 to 6 years, sort of in that COVID-19, sort of fallout phase where we had a lot of volatility, but also a lot of opportunity. And they've also learned that, the market over the long term tends to do pretty well, whether that's coming out of COVID, whether that's the 22 bear market, or to your point at the top of the show, sort of buying that dip in last spring, last April, and doing quite well against, especially compared to institutions.
All of our answers are kind of proving how retail investors are improving. And also one of the most important things when it comes to investing is diversification. And this was also one of the major themes this quarter because investors are moving away just from domestic equities. We saw in the past how investors really trusted the most domestic equities. But now when we are looking at the asset table, are there any specific areas that saw significant growth in 2025? And is that being viewed as risk management tool or more just like return seeking? What do you think, Sam?
Yeah, it's interesting. I would go down the sort of, a mix between both. But from a risk management point of view, I think as well, it's notable that their cash positions are down 3%, and they're therefore increasing bonds and commodities too. So, it could be somewhere in the middle, I would guess. But if we think about the date when this was done, and I'll just scroll down to the sheet I've got in front of me, 30th of October to 13th of November, and we talked about this podcast a lot in terms of commodities, specifically gold and silver, how from literally the 1st of December they had another massive rise, didn't they? So for those that got involved in that, I mean, it could have been at the time, maybe some of them were using it as a risk management play, safe haven, just to go in there, not expecting the returns of, silver up like 50% in December, gold up 20-30%, and they've been rewarded because of that. And it may well have been a sort of a risk management approach at the time. But yeah, interestingly, we've seen a sort of move out of domestic equities, and commodities were up, domestic bonds were up as well, foreign bonds were up a little bit more, and it's credit to retail investors that over the years they're becoming more diversified. They're identifying things that are going on, themes that are going on, and they're not afraid to pull the trigger. Not necessarily, they're not super like, day by day, I need to make a decision. They're taking their time, they're reviewing their information, and will adjust their portfolio accordingly. And, it's been a subject, hasn't it, really, for all of last year about, just the US dollar as well, about how that can change things. And they've, these retail investors have made changes based on, a lot of that information. But for those that, got into the commodity move, have benefited, even just from when we did this survey. So yeah, fair play to them. I would say they've dealt with that well. I mean, I have to say, most times that we do this podcast, I'm giving the retail investors a lot of credit, and obviously Brett again mentioning there about the buy and the dip of April. They can't really be upset at the moment, can they? Because a lot of markets last year did very well. Commodities obviously did incredible, but if you were part of that group and you're listening to this and you bought the dip in April, you're up very nicely from those lows.
Yeah, I think that's sort of the name of diversification. Sometimes it's it's gains, it's padding a portfolio, sometimes it's protecting it, and sometimes there's some pain in it. We go back a few months ago to October. You had crypto at record highs, stocks, metals obviously were doing quite well and continue to do well. But, now here in mid-February, metals are still up, but they've been volatile. Crypto's, that's down well off its highs. Markets overall, equity markets are holding up pretty well. Diversification can sometimes be a tricky balance, trying to get the right formulation for, your risk tolerance and what you're looking for. And then trying to take into consideration everything that's going on globally. Like half of the survey respondents said they're adjusting their portfolios or have adjusted their portfolios for the fluctuations in the dollar. And we know from a couple surveys ago, 2 quarters ago in the summer, we looked at what we asked investors, what are you doing for a weakening dollar? And gold and cryptocurrencies were their favored sort of assets to go to in light of that dollar. So, you might look at it and say, oh, crypto hasn't done that well. I don't know if that's a good idea, but you also kind of zoom out a little bit to your point. I think instead of being so day to day, take a longer view approach. From our end, the cryptocurrencies and commodities were the only 2 asset classes that retail investors increased their allocation to in back-to-back years. And you look at how they've done in the last 2 years, whether that's Bitcoin and ETH or silver and gold, the 2-year stretch is still pretty impressive. So, I think time frame is so important when you're looking at surveys like this.
Yeah, I think that this really comes interesting when you start when retail investors started connecting macro headlines with actual portfolio decisions. Because also, if we take a look at the stats, about almost a half, like 49%, they're planning to adjust their portfolio because of the weaker dollar. And what that means is that they are actually reacting to market conditions, and they're not just reading about currency moves. And that's very important because they are connecting the headlines with their decisions. And we can really see that already in the positioning, because gold ownership has risen for 48%, which is 3% increase from the second quarter of 2025. And I think that's not random, because gold tends to benefit when the dollar weakens and investors are looking for that stability. So what all of that is telling me is that retail investors are thinking in kind of terms of hedge and their diversification. And they're asking, if dollar is under pressure, what asset historically performed well in that environment? So it makes sense that they are reacting to those conditions and they're positioning themselves to benefit the most, the current conditions are currently on the market. And I think this is not panicking, but it's smart positioning.
Yeah, I'm with you. I think so. I tell you what would be really interesting is if we fast forward 3 months and just on that gold ownership up 43%, 3% increases quarter two 2025. You know what they're doing now? Did that blow off top and the correction scare people? Did it maybe give some people the opportunity to buy the dip and that number's actually gone up again? It'd be really interesting to see actually. And we fast forward 3 months to when we'll talk about this data again. Gold could well be back at those highs, or it could be lower. I think in truth it's quite hard to really predict with much certainty, but markets gold at the moment has recovered quite nicely from the crash it had, and looks like it technically anyway could be trying to push a little bit higher. Things can change, but it'll be interesting, that number 48%. So we'll discuss that next time. Brett, we in the report we mentioned about the sort of the investment gap between retail and institutional investors, and we're saying it's narrowing. What role are we finding that from a retail perspective is technology helping to sort of bridge that gap and maybe even leading to sort of the outperformance of other sort of institutions?
Yeah, I think that's a great point. The technology side of things. I mean, you go back, and it's not like I wasn't trading 25 years ago, but even when you go back, maybe 10 years or 15 years to find the information on why is something moving, or even find like general resources that are pretty readily available now, even if it's just the basic financials of a company, it was not so easy, that long ago. It's really changed now, where you have so much, whether it's on the technical side, the fundamental side, blending the two together. There's so many different tools. AI is also really changing the way investors, I think, approach not only like equity research, but also portfolio management, asset allocation. I think that is helping gear them towards being a little bit more open-minded in how they're putting their money to work. The other side of the equation is speed and flexibility. Retail investors now can, a couple swipes on their phone, they can enter or exit a position, and some people might say, "Oh, it's a bad thing because you have knee-jerk reactions." Yeah, but it can also be a good thing, and you can really step into opportunities. It wasn't that long ago that you had to pay, $10 a side to get in and out, and you had to go through, either a software-based platform, or that long ago you had to call in to put your orders. So, I mean, things have really changed, and institutions, they have all these, they can have constraints on allocation and how much exposure they can have to certain sectors or assets, and retail doesn't have that constraint.
Yeah, it's crazy to see how much it changed in the past 10 years. And I also think that this difference that we see among generations, it's also because of that, all of the ability of getting information fast. And we are seeing that on the market as well. Also, when you start investing, you kind of learn to invest in something that about industries, that how they work. But now, yes, it's still the case, but it's much easier to learn about new industry, something that you didn't know before, and to do your own research and to find reliable information online, and also many different angles. It's not just one source of information, but there are many different sources, and I think that really makes a difference. But talking about this report, it's really not a small sample. It covers about 11,000 investors across 13 different countries. And Sam, what do you think that this scale of this study really tells us about global nature of retail investor evolution? And how were these participants defined for the survey?
Yeah, I mean, I think our report, which I'll post in the bio for everyone to check out, summarizes it quite well. And I'll read it out now. Retail investors are leaving the dumb money label behind, demonstrating their maturity with high levels of engagement, disciplined portfolio construction, greater diversification, and macro awareness. I mean, that's like if you were a kid and you were in school and that was your school report, you'd be buzzing with it, wouldn't you? I mean, that is like a 9 out of 10 or 4 out of 5 stars, whatever you want to call it, for the retail investor. And I think that's fair enough. They had a great year last year. There was, the market was tricky first few months, but they stuck with it. They bought the dip. They diversified. So, Brett, you mentioned there, whilst Bitcoin did go to 125K, it then came under pressure, certainly in October. So, having that level of diversification softened that blow. Moving into commodities, more so as the year went on, helped as gold and silver rose into the back end of the year. Buying the dip in April helped as well. So they're doing a lot of things well. They're not being super reactive, but they are taking care and attention to what is actually going on in the market. So yeah, fair play, I think. It'll be interesting as always to see the next 3 months, because the first 3 months of this year and the back end of last year have been volatile. So, there may well be some decisions to make, and I look forward to that. But overall, I don't know what you two think, and Nezha, I'll come to you. If we gave them a score out of 100, I don't know, like it feels like 89, 90, or is that too generous?
No, I would also go with very high score, because all of the things that we mentioned are very positive. There is no impulsive reaction to mention. I know that, yes, there are some retail investors out there who still make very fast reactions based on the headlines, but it's positive to see majority of them are not doing that, and they're making smart moves. So I would also give them a score around 90. I don't want to be too generous, because I still hope that there is still space for improvements,
Yeah,
and
true.
I'm looking forward to the next report.
And Brett, for you, what you giving them?
Yeah, I love that take, Naja. I don't want to be too generous with a score, but yeah, I mean, I feel like you got to be right in that A minus range, right? Like low
Yeah, yeah,
90s, high 80s. I mean, you look at retail; they stepped in early April, and when you look at the retail volume that came in on I think it was the
yeah,
third, the fourth, and the seventh. That was those three darkest days of that pullback. They stepped in and they kept buying through that April and May rally. Everyone was calling for this is a dead cat bounce, and then it kept going. They said it's going to double top, and then we went to new highs. Retail stuck their neck out, and then they stayed in the game, and that's why they beat institutions last year. I think they deserve a good score.
yeah, I think so. So all of you that have made it to the end of this podcast, give yourself a pat on the back, smile in the mirror, but also know there is still room for improvement. And on that note, we will wrap it for today. Nezha and Brett, as always, thank you for joining.
Thank you.